Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at SLV, the iShares Silver Trust.
If you find our talks useful, please consider subscribe, like, and comment underneath. We've done the heavy lifting on the research, so let's jump right in. What makes SLV so different? We should probably start there.
We should, because it's not a normal company. This is a commodity trust ETF.
Meaning it doesn't sell anything, it doesn't have profits in the traditional sense.
Exactly. Its value is tied, directly to the appreciation of physical silver bullion. When silver goes up, the trust's value goes up. It's that simple. Pure exposure.
And that structure is, well, it's the core of its stability, isn't it?
It is. The scale here is it's staggering. SLV holds 516.5 million ounces of physical silver.
500 million. Wow.
And in terms of assets, that recently totaled $47.56 billion. And because it's a trust and it's backed 100% by the metal, it has no traditional corporate debt. Its stability is just anchored by those physical holdings.
And speaking of those holdings,
Yep.
the performance has been, well, it's been nothing short of exceptional.
Yeah, absolutely. We've seen spot silver just smash through its old records. It reached an all-time high of $64.66 per ounce.
Give us the big number. For anyone listening, what was the total return for 2025?
It was a staggering 147.86%.
147%.
And to give that some context, to really highlight the outperformance, in that same period, gold returned about 63%. So silver hasn't just been following gold. It's been leading the charge aggressively.
So if we zoom out a bit, beyond just the last year, what does the long-term case look like?
It's remarkably strong. You're looking at a 5-year annualized return of 13.67%.
Okay.
And if you stretch that out to 10 years, the annualized return actually jumps to 17.36%. That kind of compounding is incredibly powerful.
Can you make that more tangible, like a $100 investment?
Sure, $100 invested 5 years ago is now worth about $243. But if you'd held that same $100 for the full decade, it could be worth over $550 now.
And that longevity, that appeal, comes from what the analysis calls its competitive moat, right?
Exactly.
So walk us through that moat. We hear about risks with miners, with futures contracts. How does this structure get around those?
It's a really crucial distinction. It eliminates two key risks. First, operational risk. You don't have to worry about a mine in Peru shutting down or some company's extraction costs going through the roof.
Right.
Second, and this is maybe even more important, it eliminates counterparty risk. You're not trading a leveraged futures contract where you're dependent on a bank staying solvent. With SLV, you're tracking the value of real metal in a vault. You own the underlying asset.
So you're basically getting pure, low-cost exposure that tracks the metal price very, very tightly.
That's it.
Okay, so that's a fundamental stability. But stability doesn't create a parabolic move like we've seen. For that, you need momentum, you need a breakout.
And that's exactly what we have. Silver has confirmed a massive bullish breakout. SLV itself was trading recently at $84.56.
And the technicals back this up.
Overwhelmingly. Chartmill, for instance, gave SLV a top-tier technical rating, a perfect 10 out of 10.
It's a 10 out of 10.
Yeah. You see strong upward momentum, and it's confirmed by a buy signal from the 3-month equity.
Okay, wait, hold on. Let's not get lost in the jargon. For our listeners, what does a 3-month FTD buy signal actually signal?
Right, good question. The MACD is a momentum indicator. Think of it as just measuring the speed of the price change. So a strong buy signal like this, especially on a 3-month chart, it just means the recent price trend is pulling decisively away from the long-term average. It signals acceleration, real market conviction.
A textbook bullish signal. But there's always a but. You can't have this kind of speed without raising some flags, can you?
You can't. And analysts are all pointing to the same thing, an overbought relative strength index, the RSI.
So it's moved too far too fast, basically.
In the short term, yes. The RSI measures the magnitude of price changes.
Yeah.
When it pushes above 70, like it has here, it suggests we should probably be braced for a near-term corrective pullback. It's a sign of potential exhaustion.
Which brings us to the smart money. How can we tell if this is just speculative froth or, genuine institutional conviction, especially with that overbought signal flashing?
The data here points very strongly to conviction. The options open interest recently surged to 10.22 million contracts.
10 million, that's a huge number.
It is. It's over 110% above the 30-day average. So this isn't some flash in the pan. This is sustained, heavy institutional engagement.
And how are they positioned? Are they hedging or are they betting on the price going even higher?
They are decisively betting on higher prices. We are seeing what's called extreme call dominance.
Meaning more bets on the upside.
Far more. Across multiple recent trading days, call options, the right to buy at a fixed price, made up between 61% and 69% of the daily volume. That's a profound bullish skew. It signals a deep-seated belief in sustained appreciation.
And we're not just talking about small trades. There are some huge block trades that show this conviction, aren't there?
Exactly. These are the big footprints. Analysts pointed to a block of 16,000 call contracts at the $75 strike expiring way out in January 2027.
See, that's a long-term bet.
A very long-term directional bet. And another one, 19,500 contracts at the $65 strike expiring in March 2026. This is institutional money locking in expectations for much higher prices well into the future.
So if the smart money is this confident, what are the fundamental drivers? What's actually powering this thing beyond the charts and the options?
It comes down to a powerful two-part tailwind. First, you have industrial demand. This creates a permanent structural floor under the price.
And this is the whole green technology angle, right? Solar cells, 5G. Why is silver so critical there?
It's because of its conductivity. It's unsurpassed. In solar panels, you need silver paste to collect the electrons. As governments push for more renewable energy, the demand for solar panels skyrockets, and silver demand goes right along with it.
So this is real-world physical demand. It's not just about monetary policy.
Completely independent of what the Fed is doing. And you have the same structural demand from 5G infrastructure, from electric vehicles. Plus, analysis confirms the physical market is already tight, which just adds to the pressure.
Okay, so that's the structural floor. What about the other side of it? The macro policy, the monetary lift?
It's the second component. The Federal Reserve's policy is shifting toward a lower interest rate environment. This helps silver in a very simple way.
Explain that for us, the opportunity cost argument.
Right. Silver doesn't pay you interest. It's a yield-free asset. So when bond yields are high, holding silver is costly because you're giving up that guaranteed income. But when real interest rates fall, the opportunity cost of holding silver drops. So any anticipated Fed rate cuts, especially heading into Q1 2026, make silver a much more attractive store of wealth.
So you have this confluence. Structural industrial demand meets supportive macro policy. It feels almost irresistible.
It's a powerful combination, which is why you're seeing headlines calling SLV 2026's hottest trade.
So what are the actual price targets? Where do analysts see this momentum going?
Well, near-term projections range from 33% up to maybe 61% upside from here. And yes, the more speculative predictions are starting to eye that big psychological level, $100 per ounce silver.
$100. That is aggressive. Which means we have to talk about the risks. What could go wrong here? What are the biggest concerns?
There are two primary risks that everyone's highlighting. Risk number one is that technical pullback we mentioned. The RSI is high, the asset is technically overbought. A sharp corrective pullback is, well, it's statistically pretty likely after a run like this.
So how does an investor deal with that? How do you avoid the fear of seeing a sudden, say, 15% drop?
You mitigate it by trusting that structural foundation we talked about, the industrial demand, the supply tightness, that's all still there. Any technical pullback should really be viewed as a healthy correction inside a bigger uptrend. It's not a trend reversal.
So it's more of a buying opportunity, shaking out the short-term traders.
Potentially, yes. A lower risk entry point before the long-term drivers kick back in.
Okay. What's the second major risk? The macro one.
That would be an unexpected Fed policy reversal. If the Fed were suddenly forced to become more hawkish, maybe because of some sticky inflation, that would mean rising real interest rates. And like we said, that would put pressure on silver's price.
Is the market worried about that?
Not really. The consensus view remains pretty dovish through 2026. But, and this is crucial, even if the Fed does surprise us, that industrial demand for solar and 5G provides a hard price floor. That's a key difference from gold, which is almost purely a monetary asset.
And we should also mention volatility. The beta on SLV is high, 1.44. What does that mean for the listener, practically?
It just means that, historically, SLV moves about 44% more sharply than the S&P 500. It is a volatile asset. You have to expect significant drawdowns are normal, but again, because it's physically backed, the risk of a truly catastrophic sustained downside is mitigated.
So we have phenomenal performance, huge institutional conviction, two powerful catalysts, and manageable risks. What's the big takeaway? How do you synthesize all this into a strategy?
The final consensus thesis holds very high confidence. Analysts are rating it between an 8.5 and a 9 out of 10.
A 9 out of 10. That's high conviction.
It is. The rationale is clear. Industrial demand is the floor, Fed policy is the lift, and institutional money is providing the conviction. The optimal play seems to be positioning for the next 3-6 months into that Q1 2026 demand cycle, but really, the overall recommendation is for a multi-year hold.
And for anyone looking to get in now, what's the recommended entry strategy, given that overbought signal?
The analysis is pretty clear on this. Capitalize on the likely technical exhaustion. Use any near-term RSI-driven pullback as your entry point. Specifically, look for weakness toward the major support levels around $60 to $62. That lets you manage the short-term risk while positioning for the long-term upside.
That provides a very clear, very balanced roadmap. Thank you. So, given silver's unique dual role, it's both an essential industrial commodity and a traditional safe haven asset, here's a final provocative thought for you to mull over. If global economies were to unexpectedly slow down over the next year, which driver do you think will prove more resilient in holding up silver's price? The long-term demand for solar panels or the traditional reactionary demand for inflation protection? Think about that balance as you navigate this market.